Welcome, everyone. I'm the founder of Quidroom, the social platform where accredited investors and investment professionals globally find each other. Before we kickstart, for all the investors who are listening in to the session and to the podcast, if any of your questions are unanswered or to attend future investor meetups, you can join hundreds of other investors in my personal community in Quidroom. The invitation link is posted here. So today we have Deepak Shenoy, an active investor in the public markets of India, for the Ask an Investor session. Hi, Deepak. How are you doing?
Hi, Praveen. I'm good. How are you?
Well, it's an interesting market. I don't think that good might be the right way of putting it. Meh. So Deepak, look, we will be chatting about investing in India markets, about how inflation impact in the markets are going to be different this time, and why you strongly feel India will beat inflation. But look, even before we go into a topic, I always like to know and understand, and I'm sure that even the investors who are listening in would like to know exactly who we are talking to. So before we dig deeper into the current, into the status quo and the future of investing in India, it will be great if the listeners can get to know you, and especially your journey from being a software engineer to what made you an active public market investor in India. Because I've seen software engineers turning into entrepreneurs and becoming private market investors, but this is interesting.
Yeah, I mean, it's an interesting journey for me. It's as well. I've been an entrepreneur since 1998, different companies. So just a quick idea about Capital Mind. Capital Mind is an Indian regulator, that's SEBI registered portfolio manager. So we have a license to manage portfolios in India, and we manage about 100 million USD, which is roughly 800 crore Indian rupees, or 8 billion Indian rupees. We currently manage them in Indian equity and debt markets. My journey, of course, started about as a software engineer. I started my first company in '98. We rode through the dot-com boom and then a dot-com bust. Bunch of things at times around then taught me a lot more about stock markets at the time. And through this journey, it was a tech journey throughout almost, where I started off building technology products for stock market investors in 2005 and 2007. And then we set up an algorithmic trading hedge fund itself relatively early in the space in India, because algo trading was just about starting to get legalized, and there was a framework that had started, and we set up, used technology to kind of build algorithms to automatically invest. That progressed into Capital Mind as a company eventually that started off giving research and information around quantitative and macroeconomic information apart from company specific. And then when our customers told us this information is fine, can you manage our money? We got registered with SEBI, got a license, and then slowly grew the business from 2017 to now. So a little bit less than 5 years. And we're a direct to customer wealth tech based, all the terms that come from the startup world, but we're largely tech. We wrote all the tech for our management products in-house, including automated trading of all of our portfolios, managing money of customers and front-end interfaces. And of course, we invest in Indian equities, so all of our information gathering and the product manufacturing and the setup is all internal as well. So that's about me in short. But I'm probably 25% tech and 75% finance now.
Interesting, and that's great to hear, Deepak, that you came from a tech background, and then how you eventually forayed into becoming an investor, a public market investor. So it's going to be an interesting topic that we're going to be talking about today, right? Especially when Nifty's bleeding right now, and now we're going to be talking about inflation. So and its effects on investing in India. So wholesale price index inflation is at record high in India right now due to the spike in food and fuel prices, as almost everyone who understands the Indian market knows this. Uh, Now, it's pretty alarming. Combined with the current interest rates, an economy that's just recovering from the pandemic, low consumption, employment crisis, and I mean, the list goes on. Things don't look good from my viewpoint for India markets. What's happening on the ground, Deepak? Is it a recession that is on the horizon?
So India's really had only one recession in the last, I think, 40 years, and that was COVID driven. So we really won't have a recession even now. Just the numbers is that the inflation and the growth momentum is so strong that we're not going to see a contraction in GDP in any meaningful way. So for us, a recession would be something like 3% GDP growth would look like a recession for India. But the economic situation in India is only now starting to improve. A lot of the situations of the situations of the past, we've seen high inflation. In 2011 and 13, we saw 9% inflation. So India is used to it. So to a certain extent, we've seen product prices, food prices, wages go up significantly in the past. And I can tell you on the ground that it's not quite as bad now as it used to be much earlier, although there was some sticker shock for a while when oil prices went up. But Indian oil prices haven't actually gone up. Indian fuel pump prices haven't gone up so much. They did go up for a while, and then the government reduced some taxes, which they had introduced when crude prices had fallen during COVID. So in a way, that insulated us from a severe price rise. The other thing is, of course, India is importing from Russia. So in a certain extent, the fuel inflation is not as much as one would have seen in the West. Having said that, you're still seeing some level of food inflation. The wholesale price index particularly is a little weird. It's not very reliable. So India stopped relying on it for a long time back. The data collection standards are not exactly the most useful, and it doesn't consider roughly 50% of the Indian economy is services. So wholesale price index largely works with manufactured goods. So the service product inflation, which is banking services, haircuts, rents, and so on, doesn't figure in wholesale price inflation. So the retail price inflation, which is consumer price index, that's up only 7%. It was 7.8% in April, but it's come down to 7%. The RBI has actually acted much more strongly on our system. We've contracted our balance sheet from a few months even before the Fed even started thinking about it. The Fed in the US has not even contracted its balance sheet a little bit, but we've started contracting our balance sheet. We've had two back-to-back fairly large interest rate hikes and a hike in our cash reserve ratios as well. All of this has added up to a point where inflation has started to move down. Now, the biggest points about inflation that's happening in the West is wages haven't gone up in any meaningful way other than in technology, but then there's a bust coming, so who knows where that goes. But other parts of it, for instance, food and fuel, which are really more than 50% of our consumer price indexes, India makes a lot of the food that it eats, so it's not so much dependent on food from abroad, and exports are restricted. So even if prices of food go up worldwide, India doesn't see that much of an impact. Fuel prices, as I said, because we're importing from Russia, we get a substantially cheaper price. Our pump prices haven't gone up, also because the government has reduced taxes. So inflationary as an environment is not as bad in India as there is in the West for two reasons. One is the reasons that I told you. Second one is we're used to it. We've seen inflation in the past. And so if things go up 5% or 7%, we don't think of it as an extraordinary thing. And people actually expect prices, wages, rents to go up at least 5 to 6% a year.
Absolutely. So now you mentioned quite a bit of points in there. Now, of course, this is going to be more of an investment and take on this question, not a political take. I'm just going to put that disclaimer beforehand itself before I ask this question. So there is definitely a lot of pressure being put over the ties of getting oil from Russia. And in the scenario that if there is going to be, let's say, a ban, isn't that going to have a direct impact on pushing India to recession?
I think it'll push the world into recession. Europe is dead if Russian oil is banned, and it's going to be dead even if this happens in December this year. I think if that's the case, if the world has to, go to a recession in order to make these political kind of statements, then we're going to. I mean, India is not immune to that. But I think nobody's going to ban Russian oil simply because the West wants it far more than India does. India is just being opportunistic about it, but that's fine because every country has to take care of its own security. Economically, it's actually very good for us because we get oil cheaper, and it's useful for our economy to not suffer the vagaries of inflation as much as it is important to deal with the politics of the whole situation. So I think from an economic standpoint, I don't think this is a possible thing, but if it does happen, yes, we're going to get, I think the whole world will go down. So we'll go down with it. So.
Yeah, interesting point. Now, see, look, I personally think there has been this one good report that came out recently about the markets in India that makes me feel that it's a great time to invest into India. That is because the fact is that a market correction is never a bad thing. It's always a great opportunity to invest. That's how almost every single sophisticated investor thinks about it, right? And according to Bloomberg, this seems to be a record year for inflows from India's domestic institutional investors, which I think is a good sign. Investment crossing 2 trillion INR mark by this time is the highest ever for a single year in terms of the amount of money that has gone into the equity markets. I personally think the main driver for this is because they expect that right now is a time when market correction is going to happen. So there is a lot of uptick that can be expected. Do you see this trend to continue from DIIs, and do you feel that that the broader market of investors, even foreign investors, will be are now trying to take advantage of it?
A good question. India's stock ownership patterns are very weird. If you look at the management, the people who control companies, we call them promoters, but the people who run or manage companies or control them, they own more than 50% stake in the overall market cap added up. So the remaining, which is the free float of the Indian listed market, roughly half of the free float is owned by foreign institutions. And the remaining is split between Indian mutual funds, which own about 8 or 9%, some banks and insurance companies. About 9 to 10% is owned by individual retail investors. So individual retail investors own a fairly large chunk of direct stock ownership. And the remaining is a bunch of proprietary shops and a bunch of regulatory ownership of a bunch of in that. So that adds up to the rest. In that context, it's quite surprising that a domestic investor set, which probably owns only 10% of overall ownership of Indian companies, is able to kind of keep its head above water in a time when you might have expected a lot of outflows. But Indian retail investors are going more and more into domestic institutions. The pension funds in India, which have been terribly underinvested in Indian equities, have started to increase their positioning into Indian equities. Imagine something that's for 40 years only invested in Indian debt, starting to put about 5 or 10% of their overall fresh inflows into Indian equities. That's the one that's kind of created this whole motion going forward. And I think that will continue just because equities over the long term have done relatively well in India, as it has in the US and much of the West, except for Japan, I suppose. But most places like India, where you have inflation that's reasonably high, for 5-6% would be considered reasonable inflation for India, and you're getting 5 or 6% GDP growth. So nominal growth of 10 to 11% has been a standard for the last 10 or 15 years, but you're still getting fairly large numbers going in terms of growth. So a lot more domestic institutional capital is starting to move there. And our domestic institutions are very raw, very small. So now you have more institutions being built, more insurers, more mutual funds that have started to come in, and also more pension organizations. So I think this will continue for the near term. How much it manages to save markets, I don't know. In general, when markets are falling, there's a fire sale going on. It's just liquidation, so it's not going to protect markets too much. But I think it's a good idea for people to invest. I mean, for institutions to expand their exposure to Indian markets now, especially, and perhaps the next 10 or 20% down as well.
Yeah, and that actually makes me curious, Deepak. So how does Deepak's portfolio look like?
Well, all my money, most of my money is in the PMS, which is the portfolio management service we run. So we have a quantitative managed portfolio where it's called Momentum, where we have an algorithm that runs and discovers the stocks, and we actually it's very low frequency. It's probably rebalances once a week or once in 2 weeks. But that portfolio is sitting about 50% in cash, just simply because the portfolio told us. It was at 80 or 90% in cash in COVID. So we respect that quite a bit. It got to 50, 90% cash even before COVID hit us. And it was purely algorithmic. So we kind of respect that. There's also the managed portfolios which we run, which are specific to an Indian index exposure, where I continue to just maintain 100% equity over there. So I have different portfolios. So my overall position is about 80% now equities and 20% Indian debt, which overall has been okay so far. So I'm largely invested in Indian equity only. I don't have any private market investments. For whatever reason it is, I don't invest privately right now. I don't have any crypto investments, and I don't own any gold.
That's very different for an Indian not to own gold.
I don't even own real estate, so it's quite interesting.
Yeah, that is completely against the grain. Now let's just look into, so 80% equity, 20% debt. Now I just want to understand this. So when it comes to 80% equity, and when you look into that, do you usually go for the large caps, or do you have preference for the small cap players as well in India market?
We've done small, large, mid, all of them. Right now, the portfolio seems to be more concentrated towards the large caps, just because I think whatever volumes are there have moved towards the large caps. We have some small and mid caps as well. And now one of the reasons for that is some of the mid caps are actually quite attractive, even in these times. And some of them have actually demonstrated superior price and fundamental performance in the last few years. Having said that, a lot of this will change. When markets change, everything changes underneath you. So when things start changing performance and you're seeing better opportunities out there, your portfolio will automatically evolve. So I think most of my portfolios will change. And since I'm a fund manager myself, I get to be able to change my portfolios. So over time, I'm seeing more of a move towards large caps for the next few months. And perhaps later, once this entire season, winter, whatever you may call it, is over, that's when I think the mid caps and small caps will shine. So we do have a bunch of them, but I know that when liquidity goes out of small caps, you're going to find it difficult to get out or do anything meaningful with them. So got to focus on keeping it sane.
Interesting. Deepak, that actually helps quite a bit to give a overview of exactly how you're approaching investing right now, and the whole industry as well. Thanks for your views around inflation as well. Now, to summarize, what are the top 2 tips you would have for investors, especially for a lot of foreign investors who may be looking into India as a part of their portfolio to invest into India public markets, equity and fixed income combined?
Cool. Yeah, I mean, it's interesting because I think because India is more likely to deal with inflation a lot better than the West. We have the ability and process, and we haven't actually done anything that the West has in comparison. For instance, the US gave $3,200 for free and all that stuff to all of US citizens. India did nothing of that sort. So we didn't create local domestic money-oriented inflation. So our ability to get out both from a macroeconomic perspective and from an experience perspective seems to be in a better shape right now. And the elements that are causing inflation, which is food, fuel, and wages, are not actually impacting India in any magnificent way so far. The rupee is also stable at $78. The US dollar reserves have been fairly strong. So one of the things that I do think is, if you have allocations to different countries, India happens to be one of those few pockets where I think the growth will be a little bit more than normal when the growth actually comes back into the world, simply because the axis, let us say we're talking about BRIC, there is very little of the R good that's going to be left in it. And just that, and the fact that China is probably going to get a little more difficult to invest in, might leave a lot more room for India to grow in terms of as a corresponding product in the Indian economy. And given where we are, India is going to be it's a $2.5 trillion economy. It's probably going to become a $5 trillion economy by the end of this decade. And one of the reasons that will drive it is domestic consumption. It doesn't really need to be an exporting powerhouse. We have a large amount of domestic consumption. And while, much of what has happened is a setback, I think, once we cross the $2,000 per capita point, things start to move up. So I think India, from a macroeconomic standpoint, sounds interesting. What's perhaps more interesting in India than other places is India's corporate balance sheets have been battered all the way from 2011 to 2017. And they have actually gone on a reconstructive process. So if you look at debt equity ratios, you look at general balance sheets of both some of the larger banks and of the large corporates, you find a lot less to fear about now compared to earlier. So the ability, and India has not had a capex cycle for, I think, now 10 years or 8 years now. So if there is a fresh cycle that has to happen, the corporates are in much better shape to be able to lever their balance sheets when the time comes, to build in more capex, and to take on much more of the manufacturing landscape than it currently has, because China has been a very dominant force on that. So to build in more in India, that might serve the world and also for our domestic consumption. This is a very interesting point in history for it. However, I'll warn everybody right up front. India is really very tiny as a portion of world stock markets. We're like 1% of world stock market cap. Okay, we may be the 5th largest economy just in size, but our stock market caps are really low in comparison with the rest of the world. And the amount of transactions that happen here today, for instance, the whole stock market in India traded just about $8 billion. Not even 8, about $7 billion. So it's really small in that perspective. So it has to take time to build up into that size. So I think nobody should come in here thinking, we're going to get in and this is going to become a big, huge position for us in the next 1 or 2 years. It'll still take its own time to go through this crisis. And because it's small, when the world catches a cold, world sneezes, India will catch a cold. Because we're so small in comparison. So we're going to go down, with the world as it kind of tries to find its way out. But I think when it comes back up, that's when India should do relatively better than most of the other developing nations, and perhaps some developed nations as well.
That's right. That's well concluded from your end, and Deepak. So that brings us to the end of the public session. Now we are going to go into a very quick private discussion. This is going to be only for accredited investors and investment professionals, only on Quidroom, to discuss your fund and how investors could specifically work with you. For those watching the live session across social media, if you are an accredited or institutional investor, you would like to join this discussion and follow up directly with Deepak in his investor community on Quidroom, use the link provided in the comments below to set up an account. It only takes 3 minutes. Then you can join the live discussion. Either ways, there will be the recording of the session of the private discussion as well placed in Deepak's room if you missed anything. This was really good, Deepak. Thanks for all the views that you had shared. That's it for now. You were great to actually have a chat with. Now let's work towards making investments better, one step at a time. For today, we say goodbye.
Happy to help and lovely to have been here. Thank you so much for having me over. And to everyone listening, all the best. We're at capitalmind.in if anyone's interested, or come to Quidroom. I should be able to answer any questions that come in there as well. Thank you so much.